is Rob Roy of Elliott Options, and welcome to TradeFinder Live. For those of you that may be new with us this evening, just to give you a quick rundown of how things work. First of all, we start off with this disclosure/disclaimer. It's important. If you're new, take a screenshot of it, read it in its entirety when you have a moment. I'll highlight the most important things. Number one, we are not registered to give individual investment advice in the United States, and any prices are assumed to be in US dollars unless noted otherwise. So again, take a moment, screenshot it, look at it in detail when you get a chance. So if you're new with us, welcome. If you've been here before, thank you for bearing with the introduction there. So let's go ahead and take a look at the chart. So starting off, we're going to look at a monthly chart of the S&P. So here's the SPY, and we talked about this movement down, and it is really struggling with the 38.2% fib corrective level. For our subscribers, we post commentary from time to time that the subscribers can read at their leisure, and also normally do a video update, but we have changed that where we're going to do live webinars with our subscribers each and every week, going through in detail every single alert that we have in both of our portfolios and give our subscribers a chance to ask questions directly rather than just listen to a video update. So we're going to make it more interactive. I think that's going to be great. The subscribers, I think, will love it. One of the things that we've done at Elliott Options periodically is things called Fireside Chats, where I'll just come on and give some commentary and give our subscribers a chance to do live Q&A. Everybody has access to sending an email directly to me, go through support. If it needs to come to me, it'll come to me. But this is a way to be even more interactive with our subscribers. So some really cool things coming up for our subscribers on our website. But I did mention that the market was struggling with this 38.2% fib corrective level. You can see that, and the longer we went sideways, kind of coined this as the launch pad effect. When stock, market, security of any kind goes sideways for a period of time, tends to just blast off. I live on the Space Coast in Florida, so kind of the launch pad effect ties in with the space program. So that's where that came from. But that is what I've noticed through time. You can see the same exact scenario happened back here towards the end of July. We just went sideways there at the 61.8% level, and then off we went. Not so much a blast off, but a pretty decent move to the upside. Consolidated, blast off again. So is the market doing this? Is a bit more volatile here. As you can see, the daily bars are a little bit bigger, but it looks like the market is trying to go to the upside. However, we're going to have to see just a little bit more before we can say that, hey, the rocket is really taken off again. We need to break these highs going back from the 8th, 9th, and 10th of September. Now, if the market can break through those, then we could be off to the races. So we'll see. It would be surprising, wouldn't it, to see the market blast off again? But this market has been nothing but surprising since the lows back in March. Don't forget, the Federal Reserve is always a wild card. So we'll see how the next couple of days play out. But they're going to tell a lot as far as if we can break above that high level. Now, let's say we fail here and put the moving averages on. You can see that we're close just dead on the 10-day moving average. If we start to pull back, then the next target is pretty easy, the 61.8% corrective level. And that doesn't mean that we're going all the way back down here to the previous 40 yet either. I mean, that could be a potential move lower, but at this point in time, don't see that happening. We got to get through the 61.8% level first. So step by step, and that's how you work these Fibonacci levels in conjunction with Elliott Wave. So as I mentioned, I wanted to talk a little bit about some responses, and I try to answer every comment on the YouTube videos. I read every single one. If you take the time to write something, I want to give it time to read it and try to respond to each and every one. And one of the things that was talked about is we did an outlook back in January, posted in February for the Elliott Wave outlook for 2020. And we talked about the wave 3 high right at the 362 level, and we got to 360 basically before we moved back down, and talked about that being a super cycle. And then we went into the coronavirus being a black swan, all that stuff. So if you've been listening to the videos, you know what I'm talking about. Well, there was a comment that came off of, well, in your super cycle, you're using the SPY and you're only going back to like 93, where there was a definite flat surface, but the S&P has gone all the way back, to 1900. And like, I know that. I'm aware that the S&P goes back past 1993. So let's take a look at the SPX, the cash index. And I wanted to take you back and show you their comment was, no, the super cycle started back in 1929. And you can see, yes, this was an impulse move here to the upside. So again, this is a yearly chart just so that we don't have too many bars on the screen to convolute things. This is a lot easier to see. So that was definitely an impulse move. However, when we went through the Great Depression, that move was more than retraced. It came down more than 100%. You could certainly make a case for this level right here starting an impulse move, but there you go. You can see that we broke below that. Well, that by Elliott Wave rules disqualifies this pattern. So there's no way this became part of a super cycle pattern when that initial impulse move was disqualified. So that can't happen. That can't be a pattern. Now, what we could do is come over here and take a look in the 50s. Now, I could make a case here for the fact that we had this run in the 50s where, and I think you could clearly see this on your screen, right? There is an impulse move to the upside, but I want to be clear when I'm going through this. I'm just going through the SPX to give you some more knowledge, history, education, if you will, on Elliott Wave in the markets. The SPX and the SPY are different. Now, yes, the SPY is designed to mirror the SPX, and it's supposed to mirror it at 1/10, and we know all that stuff, but the charts are quite often dissimilar. So there are intricacies with an ETF, etc. So they're not always the exact same pattern. So when we're focusing on the SPY, it's because that's what people trade. The cash index is very expensive for people to trade. People trade the SPY as an ETF. That's why it was designed to be less expensive, but give people access to trading the S&P 500. So you can't just talk about those two different things like they're the exact same thing. Like talking about Ford and Chevrolet is the same thing because they're in the same sector. It doesn't work that way. But anyway, let's stay with the SPX. And so here you can see that was a pretty good move there. So that would be 1954, right, where we started to the upside. And then from that point in time, we can go ahead and do a fib retracement and look at that. So dead on 61.8% level. So when people talk about, oh, it doesn't work, technicals don't work, the proof is in the pudding. Just open your eyes and look at the chart. It's right there. So there was a big move from 1954 to 1973. So that was a good impulse. And then we came down, touched the 61.8% level, dead on the nose, and moved back to the upside. Now here's where it gets interesting. And this is what I wanted to share with you. So look how vertical we went. And granted, this is a yearly chart, but look how vertical the market started to go. So we can put on the fib extension levels here to see if we can figure out if there was a pattern here. Now, normally you look at 261.8. That's normally the highest level that we look at. We talked about this in our Outlook. So if you haven't watched the video, go look at it. It's on YouTube. It's our Elliott Wave Outlook 2020. A lot of this stuff will appear there, and you can understand what I'm referring to by watching the video. But when you're looking at where a wave 3 can go, one of the targets, an extended target, you go to 161.8, 261.8, and then 423, which is those two, 161 and 261 put together, which is just the summation series within the Fibonacci sequence. That's normally for figuring out where a wave 3 is going to go. So even looking at that, which we don't normally look at for the wave 5, the market still blew through that. So what do you do at this point in time? Well, normally we're always talking about follow the highest degree. Well, sometimes it's important to look at the lower degree. So let's switch from a yearly chart, pardon me, to a monthly chart, and you can go back and see where that same impulse move started here, right near the beginning of 1954. And if we do the fib extension and retracement levels here, starting with the retracement, boom, dead on 38.2. Now I didn't make this up. I'm not going, you know, this is what happened in the market 70 years ago, 60 years ago. And it was following Fibonacci levels back then, Fibonacci corrective levels. So when we look at that, in fact, we're about to show our next educational series where we're going to talk about diagonal patterns, directional diagonal patterns, which a lot of people don't talk about, but Elliott was big on. And we're also going to go into zigzags, which is my absolute favorite part of trading Elliott wave, great way to trade a wave 3, etc. So when we go here and look at the fib extensions here, look at where we went. There's that 261.8% extension that I talked about. So we came up here, we hit 100%. Right there, came back down, tested the previous fib level. It doesn't get any more classic than this. This is Elliott wave Fibonacci stuff. When you're going from one level and you're looking for an extended C wave or 5 wave or whatever, an extended impulse wave, we're supposed to test the previous level, which is exactly what happened. It came back down to 61.8, and then off we went to 161.8. And so then we went all the way to 261.8 on that extension, and boom, here we come back down to the 100%. So at that point in time, you would have to look at, that's a completed impulse pattern here. So we're done at that point in time. So let's take a look at starting a new Elliott wave pattern right here at this level. And now we're talking about 1970. So start with the retracement, and there we go, 38.2. What's the extension level supposed to be on 38.2? 61.8. Again, if you don't know all this stuff, watch for our educational series coming up. This is the kind of stuff that we're going to cover in the zigzags. There we went to 61.8. Boom, that's it. And back down we came. So with that, looking at the next level, let's take that one off. And here's another impulse pattern right there. And so we'll do the extensions up to 100%. So, I mean, we can keep doing this on and on. Now I'm only into the 1980 now. So that was 10 years to complete that. And I'm looking at a monthly chart. But you can see that by going through and looking at the lower degree, now that massive move that we were trying to look at from the yearly move, breaking it down becomes clear. Now you can see the patterns. This is the exact concept that we're going to be covering in that new educational series, is breaking down the waves where maybe you don't see everything on the big part of the wave initially until you start to break it down. And this is one of the things that I've always talked about that's so great about Elliott wave, is it doesn't matter what security you're trading or in what time frame. If you're trading futures or if you're trading currencies, both of those people trade on very short time frames, right? Because of the leverage that's involved. And unless you have an iron stomach, you typically aren't holding positions overnight doing those either. So you can break it down. I've mentioned many times, I look at a 3-minute futures chart. That's what I have going on day and night. I always have it on. People laugh about some of the times in the middle of the night that I'm posting videos, but I like watching the market. When the market's open, I'm fascinated by it. I'm watching it. So here we go again, all the way up to 161.8, and we break down. So there was the 100% extension, there was the test, and there was the move back to the next level. And I can do this the rest of the night if we wanted to on monthly charts. So what I'm trying to show is that this works. You can go all the way back to the beginning of the market, and it works. That's when Elliott was in his prime, was in the 20s and 30s and 40s. That's when he was really discovering how this worked, because he got sick and then he wasn't able to travel anymore. But he was physically ill, not mentally, and so he used his brain power to follow the market and create these algorithms, these mathematical algorithms to mask people's behavior, price movement, people's behavior. Supply and demand driven by fear and greed. That's what it comes down to. If you believe that's how the markets work, as I do, you got to look at Elliott Wave. You got to learn this stuff, because this is the way to determine where we're going to go. So I thought you might find that interesting, and I don't want to spend the whole rest of the night going back and going through this, but just wanted to make a couple points. One is that if you have an initial impulse that's completely retraced, that's negated, that's over with. So the 1929 argument is just not enough knowledge of Elliott Wave, how it works. That would have had to have been in the Depression, a higher low, if you're going to count that as any part of a super cycle move. That's completely wiped out. It can't start there. It can't. So that was that. Now I wanted to show you, this one has been interesting. I think you might find some interesting things out of this. We look at trade ID number 242. It's on Nike. Now notice it's still open and was adjusted. Normally what we're looking at when I show you these during the TradeFinder is alerts that were closed throughout the week. But I thought showing you this adjustment might be interesting to you. So it was out of the money butterfly. I know you all are excited about that because you always ask a bunch of questions about it when it comes up. So this was a long call, out of the money butterfly, or directional butterflies, where we place the position out of the money. So let's look at the entry here. We take a look. Here's the chart that we were looking at on Nike. There's the Elliott Wave pattern. You can see that we had this little triangle here that we've broken out of. So it doesn't really matter how large the triangle is. If it's well formed, you're going to get a breakout, a thrust move, as Elliott called it. So there was a move up to the 38.2% level. So we set the butterfly around the 61.8% level, the next target price, which is right around 120. So the wings were 115, midpoint was 120, and the other wing was 125. So 115 and 125 were the two outer wings. The midpoint, which is the target price, that's where you generate the greatest amount of gain. If you get there, and closer to expiration you get there, the better. And you can see that we used October, the month that's where the butterfly was drawn. So if we get a move to the upside here in Nike, because we're an out of the money directional butterfly, taking a normally sideways non-directional position, a butterfly, making it directional by moving it out of the money, we make money just by being right on direction, whether or not it ever makes it between those wings. If it goes between the wings, you make more. If it goes to the midpoint, you make more. If it goes towards the midpoint, close to expiration, grand slam. That's when you make a ton of money. So it's a very low risk, high potential reward strategy. And if you don't get the grand slam, normally you generate about the same amount of gain as you would have if you just would have had calls or a call spread, something along those lines. And then you can see down here at the DMI, looked really good. Positive directional indicator moving up, negative directional indicator moving down, ADX moving up, breaking between the two. Pretty doggone good DMI. So those were the particulars on entering this position. Now you can see that the adjustment was made on September 11th. And on September 11th, here was the chart for the adjustment that we sent out to the subscribers. Now look what's happened here. We're moving up and we're right near 120. So September 11th was Friday. And I'm not sure if you're aware of how they work the time value, the theta, but after the market opens, you get through about the first hour of trading, they take out the weekend premium then. So a lot of people We'll try to utilize that in weekly options, etc. But it's not that it comes out on Monday. In other words, Saturday and Sunday's theta doesn't come out on Monday. They take Saturday and Sunday's theta out on Friday. So you don't have to wait until Monday if you're looking to maximize theta decay in any sort of a position. And a butterfly does that. In other words, it allows time decay to be neutral in the beginning, and the closer you get to expiration, the more it works in your favor. So it's never negative. Theta is never negative in an out-of-the-money butterfly. It's one of the few option positions where you can put that in your favor without taking larger risk. You can do it with a credit spread. There's other strategies, short options, but you're taking on an enormous amount of risk when you put those kind of positions on. This is a debit position with a defined amount of risk that still allows time decay to work in your favor. So it's one of our favorite strategies when we have the opportunity. So look where we are. The wave 5 is at 59% extension, so really close to the 61.8% level. So we're probably going to have a little bit of an issue here. We break through that, it could be an explosion higher, and that means moving out of the wings of the butterfly. We're right here at our price target anyway. So we're at a Fibonacci resistance level, and our price target has been hit. We have Friday, so we have the time decay already out for Saturday and Sunday. We can take advantage of. And here's the big thing that's a decision maker. There's an earnings report on the horizon. Well, guess what they do, they being the market makers, to the implied volatility in the options of a stock that's moving into an earnings report? They pump it up. Right? I'm sure you've probably experienced that before. Well, having the implied volatility come out of the short options, having the theta come out of the short options, those things all work in our favor to help us generate a greater gain. So the fact is, let's say we're hitting this 61.8% level, you might be thinking, well, that's resistance. You might sit there for a while. Well, we could bounce down, we could blow through it, but yeah, we could sit there for a while. And so your thought might be, well, why in the world would you want to go ahead and take it off if you're at a resistance level and you could sit there? Because the risk reward isn't there. They're going to hold that implied volatility until the earnings report comes out, which I think is about another week away, is when the earnings report comes out. I'll give you the exact date. Yep, exactly a week. So the earnings report is a week away, well, I thought. And so this position is not going to gain value because of that earnings report. What do you think might happen if the earnings report comes out and the stock doesn't explode? What if the earnings report comes out, and Nike's not one that really moves a whole lot on earnings, but they are going to hold that premium in there nonetheless. So notice what happened. Look at the adjustment. We sold 5 contracts, but the initial entry was 6. So we started with 6 contracts, so that's a 6-contract butterfly, which is buy 6 of the 115 strike, sell 12 of the 120 strike, buy 6 of the 125. That's how you set up an out-of-the-money butterfly. But we only sold 5. Now, even with selling 5 with the price that we got, we generated a 40% gain. That's no matter what happens to that last contract, even if it expires worthless, we've locked in a 40% gain. We can't do worse than a 40% gain. But we've left one contract out there that if we were to get, as you can see, I posted a comment for our subscribers explaining what I'm explaining to you, to them, so that they could understand what's going on. So this is what I was talking about in the very beginning. Here's a perfect example of it. The communication. I mean, we like to have dialogue and communication with our subscribers, but we're leaving one contract out to where if the earnings report comes out, let me just go back and use the other one because it has the wings on it. So I'll go back to the original entry screen here. So if we have the earnings report come out in a week and it doesn't generate a significant move out of Nike and we hang around in there, the profit is going to jump considerably. So all of a sudden, we can have one contract that's a grand slam that I was mentioning that adds to the 40% gain that we've generated already. Now, just to give you an example of what I've been talking about, the price that we entered the position was 55 cents, and the fill price for closing was 78. I know that there were fills at 84, but I left our confirmed fill at 78. So leaving that at 78 cents. If you were to look up that butterfly right now, because I have it on my screen, it's trading right now for 73 cents. And yet Nike closed today at 119.27. So Nike closed at 119.27, which is right there in the middle of the butterfly, right by the mid strike, and yet it's trading a few cents less than it was trading on Friday. Why is that? Slowly pumping that volatility in, going to the earnings report. And because that's now the at the money option, which options have the greatest amount of extrinsic value? At the money. So the fact that the stock's at the money, they're pumping up that implied volatility in the at the money options, which is the midpoint of our butterfly. Now that actually takes away from the profit that we already had. That's why closing it out on Friday, at the moment that you had 3 days of theta come out and having the stock run to your target made a lot of sense. And so now we sit and we wait. It doesn't matter. We've locked in a gain. We have a nice profit regardless of what happens, but we have a potential for this being a super nice profit, home run, grand slam, whatever viewpoint you wanted to use. So I thought you might benefit from going through and sharing that with you. And hopefully this helps to explain that we do a whole lot more at Elliott Wave Options than just send out alerts. We want you to fully understand. We want our subscribers to learn from the process and understand. And I had one of our long-term subscribers, she's been around for a long time, wrote in and said, "Oh, thanks for that. I've forgotten about the fact that they take out the weekend premium on Friday." She knew it before, but it was just something she'd forgotten. Just that little tip was something that she gained from this alert. So, you know, those are the types of things that we like to do. But anyway, it's not a closed position yet. Obviously, we'll come back and update you following the earnings report. We'll see how it plays out. And hopefully, even if it does move on earnings, it works its way back within the wings of the butterfly. We have plenty of time. It's an October position. So we'll have nearly a month after the earnings for it to work its way back in. In fact, if it takes a little bit of time, that's even better. Because remember, the longer you go, the closer to expiration that you're in those wings, the better off you are as far as potential gain. So that's the education that I wanted to do from our website today. And let's take a look at the case study considerations from 2 weeks ago, where we did our very first corrective pattern. If you're new to TradeFinder, we've been doing these. I don't know how many months we've been doing these now, but up till this point, our trade consideration for each week, we hadn't had a loser yet, not one. Now taking a look at MTOR, this was on the 1st, so I have the date on the 1st, so this was 2 weeks ago. This was our case study consideration 2 weeks ago, and bringing it forward, you can see that we're down. It was at 23.95, we're at 22.78, so we're just kind of, that was on the 15th or the 8th, so that was last week. And then where we are now is back up to 23.23. This is one of the things that's a little concerning here, is that we have this triangle forming. It's not a really wide one, but it's not a very high dollar stock. So you got a $24 stock. Let's look at the DMI. The DMI is all of a sudden, with this sideways move, the ADX is diving down, which means that is legit consolidation. That's what that means when the ADX is going down like that. There's nothing really built in yet as far as a potential move. It's a real a consolidation pattern, so that has to be considered. And when you're in the world of Elliott, he talks about these triangles as being important corrective patterns for the potential breakout. And note where the bottom of this Triangle is the 50% correction from the wave 5 move. So all of a sudden now, this could be a potential zigzag to the upside. And this is where people criticize Elliott Wave by saying, well, you got the upside and the downside covered because we could correct to the previous 4. We hit 61.8. Yeah, we could, or we could go to the upside. Now, no matter which way it goes, you're in a position with Elliott Wave to win. And that's what I like about this. If it breaks to the downside, okay, that was what we had originally looked at as a bearish position moving down to the previous 4. But if it starts to break to the upside here, now we know what's going on. Now we know it's an upside target. So you take your put off and you got a call. Or you take your bearish position off and you put on a bullish position. So what? If it changes and goes the other way. In fact, with an Elliott Wave, if the original pattern becomes a failed pattern, the subsequent pattern has a higher percentage chance of occurring. To me, that's amazing. That's a great thing. That's not something to criticize. Oh, you're covering both sides, so you can't be wrong. You know, that's just people that don't want to take the time to learn this, that are making comments like that. What we focus on doing, and this is another point that I wanted to make on the chart of the SPX, is somebody saying, oh, no, you're wrong, that the super cycle started back in 29. Well, we go through and we show people the labeling and the accuracy of ProfitSource, I think, is second to none. But in the end game, it's not that important if we're the ones that get the exact Elliott Wave count right. Elliott Wave is so intricate. If you've ever taken a look at the mathematical formula, it's unbelievable. And you really have to be a math whiz to understand it. I'm not. So I'd rather look at the pictures on the charts and see what we're looking at. But if we're not the ones that get the exact count labeled correctly, so what? If we're the ones that are able to generate profitable trades for our subscribers, that's our goal. We're looking to trade profitably using Elliott Wave and Fibonacci, not sit here and be the greatest technician as far as getting every single line labeled perfectly. So, you know, I always like people to give opposing opinions, always welcome opposing opinions, but it's when people come out and say, you're wrong. Why can't you just say, hey, this is the way I see things, so, you know, I disagree. Why do we have to be hateful to each other? I just don't understand. Anyway, but here we go with the triangle, and it's just the way I broke it down. If it breaks to the downside, it follows along with this. The DMI has changed. That's the point of concern. We have a legit consolidation here. We have a 50% corrective level for potential zigzag pattern to the upside. Let's see what happens. We'll stay with the bearish scenario because that's what we started with. So we're not going to flip that yet. If it breaks out of here, then we will, and we'll change our target to the new zigzag target, which will be somewhere up around 100% with a 50% correction. Simple as that. So if we don't break down, we go up towards 30. That's the setup for there. Then last week we looked at Texas Instruments, and here's where we were last week. Now, granted, we'd had a pretty significant move to the downside, right? Everybody agree? So now we look at the 10-day moving average, which is the lime green line, and we were a little bit oversold at the time. So we talked about we wouldn't be surprised to see a little bit of a bounce, but it was the best chart of the ones that we looked at for a case study consideration. So the fact that we could bounce a little bit up to that 10-day moving average wouldn't be too surprising. And here's where we are now. So we did, and yesterday, right, the highs from Friday and Monday, touching the 10-day moving average dead on. But today we broke above it a little bit. So with that one, we have to start to look at, all right, is this one another corrective move? And you can see that we have all kinds of, I'm just drawing with arrows, all kinds of zigzag patterns going on in here. That's why I'm so excited that we have the zigzag class coming up. 61.8 is your extension or corrective level, and then the extension to 100%. We're back testing 61.8. So now all of a sudden we have a slightly different picture, don't we? Now you can see, well, wow, maybe this was just a test of the previous fib level, and the target is up here. So same scenario that we have with MTOR. It's not that we're changing our mind so that we're never wrong. It's that we're setting ourselves up to know if the original pattern becomes disqualified, we know what to do. We turn around and we flip the position the other way. Today is a concerning move or bearish position in Texas Instruments because we had that little bit of a bounce to the upside. Now that's kind of moving with where the market is right now, isn't it? So we'll see how that trades out over the next couple of days. This one, a little bit different than the market in general because it has kind of cleared those highs from the dates we were talking about with the market. So is this leading the market? Maybe. Texas Instruments could be a market leader. It didn't close above it, but it traded above it. And so that means tomorrow, a very important day as far as whether or not you would look to continue watching for this to move to the previous four, or if you would look to, hey, let's turn this around and move to the upside. I think the market is putting a lot of faith in the Fed, and that will certainly influence the market. But I also wanted to show you that we have a complex C wave here too. There's a 50% correction in just the C wave. So when we look at the extension here, there you could go up to 160 potentially to the upside with a 50% corrective level. So lots going on with Texas Instruments, but the bottom line is no matter what happens, we know what to do. So this is all part of creating a trading plan. Creating a trading plan is allowing for contingencies. I think any strategist, I went to Florida State, so I use this as a bit of an example. I became friends with Bobby Bowden, who was a great old Florida State head football coach. He's the one that built Florida State into the football powerhouse that they became. And when I was a golf pro, he loved playing golf, so I always hosted his booster tournaments. I got to play golf with him numerous times, and he knew me on a first name basis, etc. Just fantastic guy. But this is a football coach that studied Patton and famous wartime generals' battlefield strategy. And one of the things that type of a scenario, battlefield strategies, generals, that type of thing, is contingency plans. Because you have to plan ahead for what happens if things don't go as expected. What happens if things go wrong? Obviously, when you enter an endeavor, whether you're going into battle or you're putting on a trade or whatever, you expect to be right. But what if you're not? If you're not, then what do? You don't want to be caught flat-footed. You don't want to be caught without a plan. You don't want to be like, I don't know what to do. That's when you start to have real problems. We make a lot of adjustments at early wave options because of this. And we recover a lot of losses because of this. And you recover your losses when you're wrong. You take your gains when you're right. That's how we build the kind of track record that we built. That's how it works. That's what builds successful trading over long periods of time. So that's a little bit of commentary on both of those two. I think they both are in areas of concern. We'll watch for them, but now we know what to do if they continue moving back to the upside rather than the downside, which was the original plan. All right, so now let's take a look at some potential case study considerations for this week. And with what time we have left, I'll take questions. We can see there's 2 bullish impulse stocks, 131 consolidating stocks. So I think makes an awful lot of sense. The consolidating stocks, just to take you back again and show you the market really ain't gone anywhere for over a week. So we're just sitting here. We're just under the close from the 4th and 15th, so 11 days. And we've basically gone nowhere in the market. So the fact that we're starting to see the consolidating stocks pick back up again, I think that makes an awful lot of sense. There's only 2 bullish impulse stocks, and I think that we ought to take a look at them anyway, with the consideration that we could fulfill that potential blast off type pattern that I talked about that could propel the market higher. There's only 2 of them, so doesn't hurt to just take a moment, take a look at them and see what we have. PKG. So again, those are all our indicators. We covered those in the trade scan series. And here's the DMI. Now this one, if you've been here before, you know this scenario, how this works. So the way I've set up the search is for the ADX so I can capture it when it's breaking above 20. You can see it hasn't broken above 20 yet. And that means that we put it on the watch list. And the reason that I set the parameters that way is I want to be watching when the ADX breaks above 20 if we continue with this same sort of separation between the two directional indicators, because that looks great. The bulls are definitely in control. You can see the movement that we had to the upside today. So there's definitely not a changing of the guard. That happened back in August, but a confirmation of sorts with the bulls in charge. You have the ADX moving nicely to the upside, but the entry signal is if the two directional indicators keep that sort of pattern and the ADX breaks above 20. That's when we look to get in. So then we add on the Elliott wave pattern to see what we have as far as the Elliott wave pattern, and you can see that I've taken the ABCs off because we have these cool new triangle and zigzag tools, etc. So when there's no wave 5 label, it tells you that you're in a series of corrective patterns. We take a look at this, and the first thing that you notice, I think, see if we can get a triangle pattern out of this. And we can look a little bit of a ascending triangle, I think, with the A, B, C, and D. You can clearly see the A and C about the same area, but then from where the C moves, we start into a pattern of higher lows, and we have the same highs right around 110. Yeah, this is interesting, I think, more from going along with those consolidating stocks than it does a directional without the pure Elliott wave pattern. I couldn't take a look at this over here. You want to see why we like triangles and consolidation patterns? This is beautiful here. What a great example this is of how triangles work within Elliott wave. Talk about how the breakouts change. Sometimes you have it shoots off like a rocket and that's it. Other times you break out, you come back, you test the breakout. Look at that, right at the point of the triangle. So we break out, we come back and test it. Now you have the blast off move. That's the thrust move from the triangle. And then other times you have a head fake where you get this move and then it would be to the downside. So this is why people are always saying with triangles, because everybody's always trying to make an extra dollar, right? So with the way that we set up our triangles, with the triangles, we're buying an out of money call, buying an out of money put, putting the math to work for us so that if the stock moves, we make the greatest amount potential mathematically. And then people are always like, well, if it breaks to the upside, and take the other side off. And that way you can generate more gain rather than seeing, a continued loss in the option that's in the other side. Well, if it bounced to the upside here, and then you took your puts off, and then it came back down here, you'd be getting a bit nervous, wouldn't you? Because now you don't have any more protection to the downside. And if the stock didn't just come back and test the breakout, as this one did, if it was a false breakout and boom, the big move was to the downside, now you just let a nicely profitable trade turn into a loss because you got a little greedy. So we get 30 to 70% on average on those triangles. Let's just be happy with that. Take the home runs when they come, and let's not try to get greedy and maximize every position. But this is so not what I thought we were going to talk about with this stock. But anytime I see an opportunity to share something with you, I want to try to take advantage of it. And so I just saw that and wanted to go through it. CBRE, let's take a look at this one. This looks like a little better DMI here. Certainly a little bit nervous to put on a bullish position just yet. And that's because we need to see that high broken. And maybe tomorrow may be a whole different deal with the markets. But now. We'll just let it see how that plays out. Just testing the 50-day moving average. There's some basic technicals for you, aside from the Elliott wave, Fibonacci, and all the fancier things we look at. It's always, that's why I put the moving averages on there, because it's good to look at that kind of stuff too. But going back here to CBRE, just turning Elliott wave on, and still we're in another one that's in corrective mode. Potentially not the greatest looking zigzag ever here. And roughly the 62% fib level, 65 is the corrective level. Having some trouble here at the 38.2% fib extension. That should move all the way on past that 61.8% level, all the way to 100%, if that's what's going to happen. But there's a few things that need to happen first for this to continue to the upside. First of all, it's got to break through this fib level and get up to this one, which probably will have a little bit of resistance because it's the previous A high of the zigzag. If it breaks that, then you have clear sailing. So from 55 to 64 could move rather quickly, but there's some bumps along the way. And when you see that kind of thing, it's like, well, is it even worth putting a position on? What sort of confidence do we have that we're going to break those levels? Because if you're only using Elliott wave and Fibonacci, you have those questions that come up. We know how strong fib levels are as support and resistance. There's just no debate about it. You can't debate that, or you're not looking at charts if you do, or you're not using fib retracement tools or extension tools if you're going to debate that, because there's just too many examples. We've showed you thousands of them over the years with charts. But the confidence that we have is why we have the confirming indicators to back things up, and the DMI is saying, hey, this looks like it has legs. This is a strong looking trend. Again, positive directional indicator going up, negative going down. ADX is moving up. Now this time the ADX has broken above 20 already. In fact, it's about to break 25, which is what even the more conservative people using the DMI look at as the level of 25. So this is telling you that this stock is likely to continue higher. And then if you want to really get intricate, talking about following the degrees, and it seems like the theme, and it really is, the theme of the class tonight is not necessarily always follow the higher degree, sometimes follow the lower degree as well. And look, hopefully you already saw that before I pointed it out, but there's another zigzag right there. Look at that, almost the exact same corrective level. And so that one has a target price here, and then look, there's the extension level is right at the 61.8% level, and I bet the 261 is right at the 100. So all these extensions are lining up at the same spot. That's fascinating, isn't it? So now you have more than one Elliott wave pattern. I know if you're not really haven't been following Elliott wave, aren't into it as much yet as maybe you might like to be, that probably looks a little confusing on the charts to you, but just know that from the excitement of my voice, when you see stuff like that, that's what gets the juices flowing. When you have multiple patterns giving you the same price target, all that does is up the percentage of potential accuracy of that actually happening. Nothing's 100%. It never gets to 100%. It never will be. There's no system ever will be 100% as far as predicting where stocks are going to go, but it does pump up the percentages a little bit. Now, I just wanted to check before we get too excited about this, check the open interest in the options. Pretty good in September. One strag in October's got a lot. That's really too short. And it's okay. I mean, it's okay. Going out to December, there's not a ton of contracts, but there's enough, and the spreads aren't that wide. I mean, really. And it's not that expensive either. With 30 delta, not that expensive, and it looks pretty good. So that one could be, we could be switching gears from looking at corrective stocks, because let's go back here. Notice that on the corrective stocks, 0. So when you see that, it's insignificant as that might sound to you. When we're looking at a market that's trying to figure out, well, are we going to break to the upside from here? Are we going to continue down? Which way are we going? When all of a sudden you have no stocks that qualify under the corrective rules, that's when you start saying, maybe maybe we are going to break to the upside, whether it makes sense mentally or not. And I think if there's a great lesson to be learned above and beyond the power of Elliott wave and stuff, is that it doesn't matter what you think. The market doesn't care what you think. The market's going to do what the market's going to do. What you think means nothing. So follow the charts, and that's what we're going to do. So we're going to write this one down. Going out to December, potentially to the upside, and we could go as high as 55 with stops along the way of 52, so to speak. So let's just say 52 to 55, somewhere in there. So I think that one looks pretty interesting with everything that we've covered. And I've got just a few minutes left, so I did want to try to get some questions. So you guys have always been asking good questions, so let's take a look. Stocks that were bullish and now bearish. Well, I mean, that happens, doesn't it? It changes. Let's take a look at one example here. WERN. So, did you mean bearish now bullish, Kev? Because yesterday was looking more bearish, and today we kind of rebounded back to the upside. Let's look at the DMI. So the problem with this is on the ADX, I like for it to have gotten below 20 before it curls back up. Doesn't always do that. It's just a preference thing. That's kind of like when we talk about rules versus guidelines within Elliott wave. It's more of a guideline than a rule. It's just something that I like to see better. I don't think I really like this stock for at this point in time to go either direction. The bears are still slightly in control here. The ADX was trying to, it was going down. The bulls, you can see, were clearly losing strength, and it's trying to give a little bit of love to the downside move. Today could have just been simply a move back from an oversold condition. There's a bit of separation. The stock doesn't get very far from its 10-day moving average, even less than a lot of them when I talk about that. So we were a little bit oversold after yesterday, so we just came right back to the 10-day moving average. I don't see anything to change the original thesis. I'd like to see the ADX go ahead and curl back up. It's not going to do that when you have an update like that. Let's see what the volume looks like. Well, it was good volume on the move back to the upside, so that might be a bit concerning. I just don't really love that one in general terms. 50% wave 5 extension is pretty good resistance. You know, if it broke this low here, I'd feel a lot better about it going to the previous 4. Doesn't leave you a whole lot of room, but maybe enough. J&J. About as sideways. Let's see where the ADX is. Yeah, that's that. Do they have an earnings report or something coming up? Because that is really sideways. Not until October. Earnings report's a month away. Holy cow. Yeah, it's a long way. It's not enough movement for me in in a $150 stock. And we don't even have to do the triangle pattern here. You can just clearly see where support and resistance is. It would be more of an at the money butterfly, hoping that it stays sideways and doesn't react after the earnings report. If it can stay in this trading range through the earnings, then that can be a good trade. Putting on an at the money butterfly, 140, 150, 160 is a very logical at the money butterfly. That's the best trade, but you're not going to make any money on it for a month, really, because they're going to hold the volatility in it through the earnings report coming up. But after that, it could be a good trade. I just don't really see much to do with that one. There's not one that we would send out one of our strangles on. GLD. Really nice. What looked like it was going to be and you could kind of come down here and make it a symmetrical triangle, but I think the better pattern here, there's your symmetrical triangle, but I think the better one, the way it's forming now, I'll just draw it within it, is looking here with the support there. I believe this is a thrust from remnants of this tiny little triangle here, and that thrust in there, and then so much at 180, and then the series of lower highs. So this one may be morphing from a symmetrical triangle into more of an ascending triangle, but I think they're all just waiting to see what the Federal Reserve is gonna do. Yeah, I'm with you, Vince, on PKG. I think sideways is probably the best. MTR, a couple more minutes here. We'll catch a couple more. We'll wrap things up for the evening. Interesting pattern. ADX is starting to come up. Good separation between the two directional indicators. Just broke above 20, which is interesting. CCI has room. CMF is not positive, but it's diverging, which is just as good when you're talking about the money flow. You don't necessarily have to have it positive or negative. Divergence is the signal you're looking for there. And then just what jumps out is you can't miss this zigzag pattern right here. Perfect 50% correction. And look at that. There's your zigzag 100% extension dead on top of the wave 5 target. So MTR. Is this liquid? Not a bad looking pattern. It's a pretty good call. December is pretty liquid. Somebody thinks something's going to happen in December. I can tell you that. There's not much in October. One strike has some interest in September, which is almost over. But several strikes, some in the money calls, have good contracts going out to December. They may not have been in the money when they put them on, but they are now with that move to the upside. And right now, I mean, this is a pretty easy stock as far as your stop loss. So we're right here at the closing at the previous 3. It broke above it yesterday, came back and tested it today. If tomorrow looks bullish, it looks like it's starting to move to the upside tomorrow. You know, I would say that looks pretty good to continue up towards 43, 44. Yeah, that one looks pretty good. Good call. Yeah, Gunther, we have lots of education on our website about how we choose the delta, how it works with the delta curve, etc. Our strangle class has a lot of that. I can cover it some more next week, but take a look at our website. We've got tons of information on there, really cool animation that explains it extremely well as far as how it works without getting into the mathematical formula. It's in visual form, really goes into how the delta and gamma work in your favor. That's why we choose the strikes, because of that. Tremendous, great information there if you'd like to take a look. All right. One more and we'll wrap things up. WST. Sideways, broke up. That could be a head fake there. Yeah, I don't really like that DMI. The best looking thing, because you're already in extended wave 5, so then you're looking, are we going to 161.8? Well, you would want to see the DMI give you some confirmation of that. Maybe it will in a day or two. It's not there yet. It looks like the bulls are trying to reassert themselves. Crossover that probably occurred yesterday. You want to see that ADX turn back up. Remember, it lags a little bit, so paying attention to the 2 directional indicators is the first step. But the thing you have going for you most is there's a ton of resistance right there at 280. So we broke above that today, 284. If you break back down below it, if you got a bullish trade on, you take it off, because that's super easy to see the support level there. So if you wanted to make an aggressive bullish trade, you could do that and understand that it's a bit aggressive at this point because there's really not the confirming signals behind it that we like yet. They could get there. That's why I'm saying it's aggressive now. And if it breaks back down and closes back down below 280, you just get out. That's the way that you would work that one. I hope you found tonight informative. I kind of thought it'd be interesting. People periodically bring up the SPX, so going back to look at that, and you just saw how many Elliott patterns moving forward from 1929 that were, and I think only made it up to 1970 or 80. We had 40 more years that we could have gone through and done that, spend the whole night doing it. But hopefully you found that informative. I appreciate your attention as always. Look forward to talking again next week. Take care, everybody.